return structured products are fantastic. Let me tell you what they do. They give you leverage in the direction that makes you money, and I'm talking big leverage. This could be 200%. This could be 300%. Rudy and I have even seen some that are 500%. Let me give you an example so you can see what I'm talking about. Say you have one that's based on the Dow Jones Industrial Average. And the Dow Jones Industrial Average appreciates in price by 5%. If it's 200% leverage, you're going to go ahead and generate a 10% return. If it's 300% leverage, that 5% is turned into 15%. This is huge, because if you're faced with mild to moderate market conditions, these can transform mild to moderate market conditions into bull markets for you. Now, what are they typically offered for? They're typically offered on major stock indices like your S&P 500, like your Dow Jones Industrial Average, your NASDAQ, but they could also be offered on sectors. If you're bullish on technology stocks, if you're bullish on energy stocks, there's a play available for you. They could also be available on commodities, gold and oil. Very powerful tools. An attractive feature is that leverage is asymmetrical. All it means is that the leverage works only in the direction that makes you money, not in the direction that would cause you to lose money. Let me give you an example. Before we talked about leverage to the upside, where you could turn 5% at 200% leverage into 10%. What happens if it drops, though? If the structured product that it's based on drops 5% in value, it's not a 15% loss. You only have a 5% loss. Very powerful combination. Now, some of them have this wonderful feature called buffers, which is really just a fancy term for cushions. These cushions typically are about 10%. That means that if the underlying investment security that it's based on drops by an amount less than that buffer or the cushion, you have no loss whatsoever. Let me give you an example so you get an idea of exactly what I'm talking about. Say you buy one that's based on the Dow Jones Industrial Average with a 10% buffer or a cushion. And between the time you purchase it and the time it matures, the Dow Jones Industrial Average drops 9% in value. The 10% buffer or 10% cushion means that you would have no loss whatsoever. That's no loss. Now, what happens if the Dow Jones Industrial Average dropped 15% between the time you purchased it and the time it matured? Guess what? That 10% cushion, 15% minus 10% equal only a minus 5% loss. Instead of a 15% loss due to the cushion, you have a 5% loss. Now, I want you to compare that to a 15% loss in your mutual fund, in the S&P 500. There's no downside protection whatsoever. So these, what are called buffered return or enhanced structured products, can give you some downside protection. And what about the leverage as well? How many mutual funds underperform the stock market? How many separately managed accounts underperform the stock market? The use of this upside leverage in the direction that makes you money has the potential to turbocharge your returns. And of course, just with any investment vehicle, any strategy, there are weaknesses in some cases. The weakness with enhanced structured products is that in exchange for the upside leverage, number two, in exchange for the cushion, there's what's called a cap or a maximum return that you can make. That could lead these to underperform in strong bull markets. Thus, these are best. The sweet spot for these are best for mild to moderate bull markets. As you can tell, these can be fairly complicated. There's multiple moving parts. There's asymmetrical risk-return profiles. That being the case, we strongly suggest that if you're an individual investor, if you're a financial advisor, team up with an experienced portfolio management team that knows how to handle structured products.